Let's take a look back in history to 16 years ago when a two-day, $200 billion run on money market funds began on September 17, 2008. It started when the Reserve Primary Fund, the OG money market product created in 1970, broke the buck. An admission that shares were no longer worth $1 as promised. This after its holding of debt plunged in value when Lehman Brothers collapsed just a couple of days earlier. That triggered widespread panic among investors and other funds, with industry-wide redemptions averaging about $100 billion per day on September 17th and 18th alone, according to the New York Fed. And all told, around $310 billion, or around 15% of total assets, were pulled that week, according to the Government Accountability Office. That compared to just $7 billion in withdrawals the entire week prior. That stunning reverse tsunami forced money funds, the largest collective buyer of unsecured short-term loans known as commercial paper, to stop purchasing them and start selling them, shutting off corporate cash flow and freezing credit markets. We know what happened. The run on the bank, if you will, only abated after the U.S. Treasury and the Fed stepped in. Remember, money market funds back then were considered among the safest investments, but key to that perception was being able to keep the fund share price fixed at $1. That was known as constant net asset value. Think of it this way. $1 deposited in a bank is always worth $1. You know that. But $1 in a money market mutual fund is buying a share of a pool of loans made by the fund, and those loans, the value of which can go up or down. In the wake of that panic, the SEC in 2014 passed rules aimed at protecting investors, but those rules were tested once again during the pandemic when investors did another run, yanking $125 billion out in March of 2020 alone. That led to another infusion of capital from the Fed and another round of regulations for the industry, regulations that largely take effect next month, and it couldn't come at a sooner time. A record $6.3 trillion in cash is sitting in money market funds right now. That's triple the assets held back in 2008, and J.P. Morgan expects that to grow by the end of the year, even as the Fed starts to cut interest rates.